Welcome to another PA Political Digest podcast. I'm your host, Christopher Nicholas. On today's podcast, can we bridge the gap between high-level stock market data and all the economic stats we are flooded with during campaign season? Can we do that with our regular kitchen table family budget? Economic jargon and buzzwords are part and parcel of our body politic, especially when we talk about the economy. Let's try to provide some clarity on that as we head into campaign 26. To help us do that, to demystify some of that economic jargon, I've invited Heather Long onto the PPD podcast today. Heather is the chief economist with Navy Federal Credit Union. You can see the little sign behind her. There you go. Heather is also a Rhodes Scholar and a former economics correspondent for CNN and the Washington Post. She also worked as an editor at the Patriot News here in Harrisburg, where I first learned of her, and she wrote their Cheers and Jeers column. Heather graduated from Cumberland Valley High School in Cumberland County, about 30 minutes from where I sit today. Welcome, Heather.
Thanks for having me, Chris. Yeah, my family, my folks still live in Mechanicsburg, Pennsylvania, so I get up to PA a lot. Honored to be on your show.
Thanks for coming here. I was trying to figure out how to intersect wanting to demystify economic jargon with the fact that we are obviously a Pennsylvania-oriented newsletter and podcast. And then I saw you somewhere on Twitter, and I was like, there we go. That's the perfect intersection for me and for our viewers. So we're going to get to a bunch of topics, so I'm just going to hop right in here. I'm basically going to ask you some questions about what we hear and how does that translate into our usual lives and what does it actually mean. So we are inundated with talk about the inflation rate. Every month we seem to get the inflation rate. Last month was X. So does lowering the inflation rate mean that prices at the grocery store will roll back, or does it mean that they'll just increase slower in the future?
Yeah, you got it. The second one, the latter one, you said that it's just a slower rate of increase. You can have deflation, which is when a price is actually going down, and we've seen some of that. Look, gas prices are down 30 cents from where they were a year ago. I certainly see that when I go and fill up my car. I'm sure many of your listeners do too. So there are some prices that move around in the economy. But by and large, most prices are going up. And what frustrates people is when economists and policymakers get on TV and say, oh, inflation's cooling off, it's easing, it's looked better. What they're really saying is, okay, we have, 2.7% inflation instead of 3.1. And for most people, there's not a lot of difference there.
And I would say that, using the immense knowledge I learned at American University umpteen years ago when I got my minor in economics, inflation in some areas doesn't hit you as much because people don't buy refrigerators every week. But every week, people usually they're buying gas and they're buying food. So I have, the same feelings I think a lot of people do when I shop. I happen to shop at the Giant, but it doesn't matter where. You just keep thinking, boy, if there's any easing with inflation, I'm not seeing it here on aisle 11 when I'm shopping for peanut butter.
Yeah, you've got it. I mean, this is a point I've been trying to make when people say, oh, is this affordability conversation a hoax? I'm like, look, you can look at this a lot of different ways, but most people are doing what you're saying. They're really paying attention to what I call the big five of their budget. And you're right, groceries, food at the top of the list, electricity you got to pay your electric bill, your housing costs, whether it's a mortgage or a rent, and then healthcare. You got to pay some sort of healthcare. And then it depends if people have to pay childcare. If they've got young kids, they sure know what that bill's like. And the reality is, if four of those five items have grown faster than wages in the past, since the pandemic, in the past 5 or 6 years. And in the past year, the past 12 months, while some prices have moderated or even gone down, like the gas price example we were talking about, overall grocery prices are up a little bit faster than pay. and electricity has really skyrocketed and become a big talking point. So you're right. These are the basics. A lot of people, and we can see in our Navy Federal data, have not been buying some of the stuff hard hit by tariffs. They've pulled back on their spending on appliances and furniture and gardening equipment. They don't have to buy those every year, but we can see the growth. They're going to Costco. It's like crazy growth in Costco spending as they try to stretch every dollar on food.
So you mentioned there from your Navy Federal Credit Union data. I think all of those words are self-explanatory, Naval Federal Navy Federal Credit Union. But give us some idea of what that is and what you do there as the chief economist and the data you can draw on from your perch.
Yeah, it's one of the best viewpoints to see the middle class. What's the health of the American middle class, both military and civilian? We have 15 million members. That's not everybody in the economy, but it's a lot. We serve a huge proportion of the active duty military workforce. But then there's a lot of people like me who joined Navy Federal because my father had served. I've never served myself, but I really enjoy being part of this credit union long before I ever thought of working here. And anyway, we can see in real time, we got millions of transactions every day on people's credit cards, debit cards. And when people say to me, well, there hasn't been much impact from the tariffs, I say, whoa, I can show you how much spending, where people are spending has shifted. That doesn't mean they've stopped spending, but there's just been this massive rush into these warehouse and value stores like the Aldi. I don't know if Aldi's come to parts of Pennsylvania or Lidl or those cheaper
Yep.
grocery stores.
Yes, we have those. Yeah.
Yeah, obviously Costco, Sam's Club, BJ's, it's just been like 10% year over year growth. And then people are not spending as much. I hate to say things like Target, but stuff that used to be seen as more of the middle class shopping, they are going to the budget and discount places. Even wealthy people, even people who make over $150,000 a year are worried.
Well, your budget, whether it's for your family, for your church, for your company, it's all about allocating your scarce resources, right? And as prices go up in one area, I know my church budget, I'm on the church council we call the vestry, and our utilities across the board have gone up. And while we were preparing this year's budget in the last quarter of last year, we really had to, take account that we were going to just have more of our, you know, dollars go into utilities. Um, and people don't go to a church because it has utility, heating and air conditioning, but you have to have it. So
Yeah,
it
hard to
you
sing
have to
with the lights.
allocate. Yeah, you have to allocate from something else to that. So I was going to get into this later, but you kind of prompted me there. You have talked about something I think you have termed the K-shaped economy or the K-shaped economic recovery. Why don't you fill us in on what that means?
Yeah, it's interesting. Most non-economists get this right away and they send me notes like, this makes so much sense. But whereas economists are like, this wasn't in my textbook in American University, 30, whatever, however many years ago. But look, so the basic idea of the K-shaped economy is similar to the rungs of the K. There's a contingent in America that's doing well, their income's growing, their spending's growing, their stock market holdings are growing month after month, the rising K, and then there's everybody else. And in this case, the everybody else who's sort of they may not be totally falling down the cave, but they're definitely treading water. Let's put it that way. And so it feels like they're getting further behind the people who are on rising. And look, it's the bottom 80%. So that's a lot of America. And I say to people, the new dividing line in America is $170,000 a year. Some people put it at 150, some people put it at 175, but you get the idea. Somewhere in that range. And basically, you can see it starkly in our data and the national data. People who earn above that, at month over month, they're living La Vida Loca. They're still spending trips to Europe or Asia or, big birthday parties, buying the grills, buying the cars. The huge surge in purchases of new cars for families earning 150,000 and over. And then there's everybody else. And everybody else is doing what we were just joking about and shifting to Costco and shifting to Walmart and spending more of their dollars at TJ Maxx. than and pulling back on travel and home improvement.
So, people's budgets change every month. The government has a different budget every year. And one of the things we hear about on the national level is something called GDP, the gross domestic product. Fill us in on what that means and what it means to the economy. And is it something we should listen to when our politicians talk about it?
Yeah, look, I mean, it's not the perfect metric that covers everything, but it's the best gauge that we have of how the entire nation and every single industry, from small business to big business, from manufacturing to the influencer economy, is growing. You know, how fast compared to last year are things expanding, sometimes contracting. We also can have moments of recession when things are shrinking. And so it's the economic pie. It's the best measure of is the pie getting bigger or smaller. Historically speaking, the number to keep in your head is about 2%. You know, 2% is kind of what most economists and historical data shows us is a typical year. You know, it's good growth, not great growth, but kind of good, solid, B plus if you're a high school teacher. But lately, look, the reality is lately, the last two quarters we were at over 3%, and then the last quarter, Q3, that we saw over 4%, 4.4%. And look, you don't need to have a PhD in math to realize that's a pretty big difference between 4.4 and a 2% typical quarter. So yeah, that you're right. There's this dichotomy right now. You know, the stock market's at record highs. These GDP growth figures look like a boom. And then, you got all these people worried, shop moving to Costco and Aldi, and you've got this anxiety and you've got almost no hiring going on. And that's a very rare circumstance to have that much growth and almost no hiring. What's going on?
How can you get to 3 or 4% GDP in a quarter without any net new hiring? I mean, what happens to make, is it just those people above 170 splurging and spending more? Is that what is it all being pushed by consumer spending?
Yeah, there's a lot going on, but here's the best way I reconcile these two stories of the economy, these two realities. Number one is the K-shaped economy that we were talking about, and if you are in the top 20 or so percent, you've been benefiting from those stock market gains, and you've been benefiting from the second point I would make, AI boom. You know, you could see it in parts of Pennsylvania trying to build those data centers,
Yeah.
just massive growth and investment in artificial intelligence. In the first half of 2025, there was as much spending and investment and contribution to our GDP, the economic pie, from AI investment as there was from consumption, which is just mind blowing. The first thing you learn in any macroeconomics class is the US economy is a consumer economy. You know, when people spend things, the nation does well. When they don't spend, it doesn't do well. And yet that was almost blown up in the first half of the year last year by AI being such a huge player. And so the third factor I would bring up, I call this a jobless boom. So the good part is it's a boom, we're growing. The hard part for a lot of people is show me the jobs. You know, why isn't my college student getting hired? I'm stuck. I feel stuck. I can't get another job even though I currently have one. They can feel that the shift in power dynamics in their company, that they're being told to come back to the office more, their perks are going away, the bonuses are getting harder to get. They can feel the squeeze that's coming. And I think some of that is the result that there was overhiring in 2022 and 2023, and some of that's coming back. And look, people don't like to talk about this, but some of it is due to policy. What would you do if you're a CEO and you've just been hit with a ton of tariffs? You go, weird, this immigration crackdown. You've got a lot coming at you right now, and your natural impulse is to be conservative in the sense of with the budget. And oh, by the way, I'm trying to invest a lot in AI and move my money over there, so there's just less money for hiring.
So more money into machines and algorithms and less money into people.
Yes, exactly, Chris. This is the biggest mistake I hear. People will say, well, AI is not replacing jobs. I say, no, by and large, AI today, machines today are not replacing workers. Maybe a few young coders, you could argue. But what they're missing the point. AI investment is replacing workers in the sense of there's only so much in your church budget or in the company budget to go around, and companies are using those dollars for technology investment and not to expand headcount.
We all always hear also every month or every quarter, we hear about the unemployment rate. And we hear about the unemployment rate for the entire country and then for, Pennsylvania and all the other states. And these numbers have seemed to me to be low. Some economists have said that full employment is basically 2.5 to 3.5% unemployment, if I'm remembering correctly. And our unemployment rate here in Pennsylvania is 4.1, 4.2 in a very narrow trading range. So how should we interpret the unemployment rate when a politician stands up and says, it's low? Because I don't think most people, if you stopped them on the street, would believe you when you said GDP growth was so high at the second half of last year and the unemployment rate is really low. I don't think people would say, oh, yeah, that's obviously true. I think they would beg to differ.
Until you were speaking, I hadn't thought about this, but you're right. The GDP in the third quarter was 4.4%. And guess what? The unemployment rate at the end of last year was 4.4%. You're right. Those two things are not normally the same. Um, so when I first took economics, a quarter century ago, we would talk about anything under 5% unemployment being pretty good. Now you're right. Our new world, we kind of are hoping for something around 4%. So we're at 4.4, not terrible, like you say, by historical standards. But let me flip this a little bit on its head. We are in what a lot of people are calling a no hire, no fire. So not a lot of people getting laid off, and that's why that rate is still pretty low. But it's this weird, freaky world where, like we were talking about, there's no hiring, and for a number of reasons. But here's something I like to keep in the back of my head. If we had the hiring rate that we currently have, this very low anemic hiring rate, it's similar to what we saw when I lived in PA in like 2010, 2011, 2012, coming off the Great Recession when there was almost no hiring then. But the unemployment in those days was 7, 8%, high. And so, that's where this mismatch, that's where this is really hard, you're right, for a lot of people to reconcile is, okay, they tell me it's a low unemployment rate because people aren't getting fired and laid off, but there's no hiring. And so it feels more like a 6 or 7% unemployment rate world in that context.
If you were an incumbent politician running for reelection, you want to stress that things are doing well. If you're a challenger trying to unseat an incumbent, you're trying to portray things as bad getting worse and people need to make a change. So for you, I'll put you on the spot here, Heather. Uh, Give me the three best arguments for uh, the process that the economy is doing well, and three arguments why it is not doing well that our listeners might hear from competing politicians. So first off, what's the case for the economy is doing well?
Yeah, I mean, you can see the White House doing this, and it's very smart. You or I would do this if we were there too, and that is they are emphasizing those great GDP figures. They're emphasizing not only that it's 4.4%, but that it's way higher than a lot of economists predicted, and that's certainly a fair criticism to make of the economics profession. I think too, people, I was very fearful of the tariffs, I'll admit, back in the spring. What could they do to our economy? And while prices are up and some people are paying those, I think the White House has done a good job of saying it's not calamity. Not only is there no recession, and it is a boom, time in many ways. And then I think their best argument, and I've heard them make this, at least Scott Bessent, the Treasury Secretary, some of the people who are good economic thinkers, we could disagree on certain points, but I have a lot of respect for him. I think, look, he says it well. He's like, look, it's just the beginning. Kind of trying to say a rising tide will lift all boats. We've got the wheels running, we've got the economy growing a little hotter, and just give us time, give us a few more months, and more of the middle class will feel that. And I hope they're right. I think things are growing. I think you could get to a point in later this year where companies do want to hire again. They say there's no recession. They see things are going in a positive direction. And honestly, what would really help is if we weren't threatening Greenland, like and things like this that just send everybody in shockwaves. If you lowered those shockwaves, you could be in a pretty good place.
Okay, so let's flip that around now. Suppose you're trying to make the argument that the economy is not good and getting worse and things need to change. That will obviously be the message to some extent from the other side, from the Democrats.
I mean, you're hearing it. You're already hearing it. The affordability case, you've brought up too. A lot of people are feeling and seeing the rising grocery prices and electricity prices and hammering those. Healthcare has been another strain this year since the Affordable Care Act subsidies weren't renewed. And frankly, even people, who have employer insurance saw a pretty big jump. The average increase was pretty sizable, high single digits this year. So I think emphasizing the basics costs that are rising and then emphasizing the lack of hiring. I mean, that in many ways, that's usually a sign that businesses are not confident if they're not hiring, and so yeah, I think all those have played out on the Democratic side. And the big one is security. There's just um, this isn't really necessarily a President Trump problem or Republican problem right now, but just there's this feeling in America that people just feel like they're financially insecure. And so I think either party really needs to do a better job of addressing that.
I would put it as to relate back to that what I think was a good ad campaign. I think people are looking for an easy button. Things have gotten so much more complex with healthcare, and now you have to shop for your electricity in a lot of places, and AI and all this stuff. They're looking for some part of their family life to be able to hit that big red easy button, so things are less complex, and it takes a load off their shoulders.
Yeah, amen. That's why you do politics and I do economics. But I think you got it, and I think it's really interesting to see some of the experiments going on, whether it's, you can think whatever you want about the New York City mayor, but can he get something done on childcare, which is obviously a huge issue across the nation? Certainly housing is the other big one. We were talking about four of the big five affordability items in the
Yeah,
budget, going up more than wages over the past 5 or 6 years. Well, housing is by far the most. Wages are about 29%, and housing is up 55%. And I think we all see that. You just drive around your neighborhood and you think, where did all these $1 million homes come from? But,
what
there's good
I,
and bad. If you own the home, it's great, but if you're trying to get in, it's not so great. Um,
Exactly. It's a two-edged sword with housing costs. If you're about to sell a house you've lived in for a while, you like the fact that it's appreciated. If you're trying to get into your first house, you don't like that fact. I was talking to my younger son about this, who is in the process of moving back to Central PA. And he mentioned to me how some stats he saw somewhere that the average age of a home buyer is now much, much higher than it's ever been. So, one, are you seeing that through your prism there at Navy Federal Credit Union? And if so, does it make a difference?
Yeah, so the that median first-time home buyer age just hit 40. And,
Wow.
that's just astronomical. You dial back to kind of, the 80s, early 90s, and you were looking at something, in the mid to late 20s. So you can just see, how that's a whole almost generation gap that people have to wait all those extra years to get going in their adulthood. And so it's definitely the number one issue for young people. We see it at Navy Federal. We see a lot of people who become almost, they're so, it's like no hope. You were talking about the easy button, but I sometimes think we got to push some sort of hope button and for the future, because sometimes people they think, why should I even bother to save? What I'm never gonna retire, I'm never gonna be able to afford a home. It's like they don't think the American dream is real. I will say at Navy Federal, I'm proud to work here. It's one of the reasons I joined, and I'll try to keep my soapbox small, but obviously we do a lot of VA loans through the Veterans Administration. Those are usually no down payment or very low down payment for military members, which is great. We should do that. as a nation. But we also offer from Navy Federal what's called home buyer choice, where people can put 5% or 3% down, or even a little bit lower, depending upon their qualification. And that's been a game changer. People are on fire coming to this because they can't, if it's going to cost $1 million, and you got to put 20% or even 10% down, that's $100,000, to even get your foot in the door. And so I keep stressing this 50-year mortgage idea is kind of a joke. Don't do it. But if we could just, build more homes and we could do a little bit lower down payment, I'm not saying everything would be perfect, but wow, it would be a chance.
Well, it would be nice too if we get some regulatory relief so the people who build homes could build them faster and this, a
Amen.
little less expensive. So those first time folks, I've always said about Central PA that it's a pretty good area for first time home buyers because we're kind of a steady eddy. People have been building houses here for 70 years. We didn't have a big, huge boom or bust. So you have a lot to choose from. And thinking back to the average age of 40, which is wow. For decades, I remember the 50s, the 60s, the 70s, the makers of home appliances, refrigerators, washers, and dryers, they would chart how many people that next year were turning 25. And that's how they gauged their production of how many more refrigerators or washer dryers they needed to make, because 25 was the age back then when people would settle, couple, and nest. And, when you're a single guy, you're not really worried about a refrigerator. But then when you settle down, you get engaged, you get married, well, you got to think about that stuff, right? So 40 is just, I mean, it may not seem a lot to people, 25 to 40, but that's a huge change. And if you're a home builder, then you're building different types of homes because people who are in their 40s might already have kids.
Yeah, it's a
And
huge
so
difference.
anyway, that was my little soapbox.
Well, I'll
So
put in one small plug for Central PA. I know you just did. It's certainly still more affordable. But I actually, one of the last pieces I wrote at the Washington Post was how we need to build more smaller homes. Now, that could be townhomes, that could be homes like in Houston where you reach out and you touch your neighbor, but at least you have a small strip of grass between them. But the idea is what happened to the 1,400 square foot or 1,200 square foot home that is more affordable. And I have to say, Central PA was one of our examples of a place that has had a lot of boom in townhome construction. And I know people miss some of the more rural feeling in parts of Central PA, but I think it's actually a pretty good. They built a lot of homes, which is what's needed.
Well, your part of Central PA, Cumberland County, has been either the fastest or the second fastest growing county in Pennsylvania for a while, kind of vying with Chester County, which is suburban Philadelphia. So um, the Federal Reserve, we hear about that all the time. I saw a poll recently that the only Trump appointee with a positive uh, job rating was Jerome Powell, who President Trump is trying to get rid of now, but he actually appointed him back in his first term. So, first of all, does it matter who the Federal Reserve chairman is, or can we just tune that out? And then, how does the Federal Reserve, what they do in their boardrooms, impact us in our daily lives?
All right, you're hitting to my bread and butter here. Yes, it matters who the Fed chair is. I mean, similar to in the legal world, it matters who's on the Supreme Court. First of all, just on the Fed, you need somebody competent. You need somebody who knows a little bit about business, economics, or markets. Doesn't mean they have to be the Nobel Prize winner, but you want somebody with the financial background. And look, it matters a lot for two reasons. Number one, huge impact on the economy. Remember in the COVID times, part of the reason that we didn't have a new Great Depression in 2020 is because the Federal Reserve intervened really, really fast in March of 2020 before Congress. They acted pretty fast for Congress, but they didn't really get the money going until April. It was the Fed that really came to the rescue. And similar, every Fed decision, when they're going to do one soon, they do every 6 weeks. It immediately flows into what mortgage rates are, what auto loan rates are, what business loan rates are, and ultimately they try to keep the economy out of a recession. So it's a huge job, very important job. You want somebody who not only looks the part but has the actual chops to do it. And look, secondly, I think the reason that there's so much attention on who President Trump's going to nominate and ultimately who will get confirmed is because credibility matters in this job. Similar to the Supreme Court, but even more so in the financial world. And it took decades to build this up, credibility that not say every decision's perfect. They made some mistakes in 2022, a little slow to address inflation, but they course corrected quickly. And you don't want somebody who's just going to do whatever the politicians want. We need people like Paul Volcker back in the 80s who are going to make some really hard choices to get America back on track. And this is a huge reason that America is the envy of the world in our economy, because by and large, we have done the right thing and we've kept a pretty stable environment to run businesses and live our daily lives. And we can all pick a bunch of holes in that. We've been doing that in this conversation, but anyway, that you can hear the banking people, Wall Street people have been calling the White House and frankly weighing in on this because even these CEOs who you think, oh, where don't they care about what's going on in America? Oh, you better believe they care about who the next Fed chair is. And there's been a lot of back channeling to ensure
They
the
they care
person is
about their cost.
confident.
They care about their cost to borrow.
Yes, they
To
do.
to demystify this a little bit more, when the Federal Reserve changes interest rates, that's essentially the interest rate at which banks can borrow money. And if it costs less for a bank to borrow money, then they don't have to charge you as much interest, and then vice versa. People who have adjustable rate mortgages are tied into that. A lot of times your credit card rates are prime plus some 15%, 20%, whatever the case may be. So one of the proposals out there now is to that President Trump has trumpeted recently is capping interest rates on credit cards to 10%. Now I have credit cards and my interest rate is not anywhere near 10%. So that seems like a good idea to me. But I have also heard stories about how that would basically force a huge contraction in the credit card industry and fewer people would be able to get them and might have to do things like, payday lending and other, somewhat sketchy things like that. So is the 10% cap a pipe dream? Is it going in the right direction? Should we just forget about it or what?
I'm probably a good person to ask about this. Here's why. So, the average credit card rate in the United States at the moment, depending upon what data you look at, is 22 to 25%. So,
Okay.
pretty high. You don't want to be paying that interest if you can avoid. But as a credit union, our highest credit card is 18%. Now that's not 10, but you can see you don't have to be charging 25% to run a viable credit card business. So there is a debate to be had about we've never had a cap really in the United States. There is a cap for military. You can't go over like 36%. But let me give you the flip side. So I think there is room to have that debate. Should it be so onerous on people who need this? The flip side of the debate is it's pretty risky. Every month there's people who we write off, and every financial institution does. They're never going to get that money back. And so, particularly younger people who are newer to credit or have poor credit. And so, if it were to go to 10%, let's just say March 1st, the reality is there would be a fewer people who would get access to credit in the United States. And frankly, some people might have their credit card canceled. We don't have plans to do that in Navy Federal, but realistically, some parts of the industry would probably do that. And so you're right. I think it's a conversation nationally to have, but I think each point, every time you ratchet that number down closer to 10, the trade-off is probably millions of people would not have access to a credit card. So it's a dicey game.
Well, to me, it goes back to your K-shaped uh, issue. Some people would benefit from that because of whatever their credit score is, and other people trying to get into the credit score system, people coming out of the military, younger people, would find it harder because credit card companies would say we can't enroll new people at 10%. Well, maybe it's not 10, maybe it's 20. So I think it's an adroit play by the president to at least bring up that subject and to have a conversation, because no one thinks their credit card interest rate is too low. Okay.
Yes, yes,
No, no
exactly.
one, no
Yeah.
one thinks that.
And look, when people ask me, I say, look, I give the president credit for trying to bring up a lot of ideas recently, to try to help in affordability. We can debate, okay, which ones, like the 50-year mortgage, you could hear I'm not a fan of, and I don't think would be helpful. But if I were the White House, I would make this the year of affordability, year of housing affordability. I would just keep throwing ideas out and testing the waters, because that was President Biden's big mistake. Oh, I feel your pain, but people didn't feel he was taking action. There needs to be action.
So, as we get towards the close of this podcast on PA Political Digest, I was looking through some research on you and saw something that you had talked about, called the vibe session, or the kind of the vibes of the economy. Explain what that is.
Yeah, sure. Well, full credit, there's a young economics influencer named Kyla Scanlon who's great on TikTok, and this was really her term that she came up with during the Biden years. And that was this notion that the hard economic data, like we were talking about GDP or unemployment rate or inflation rate, was looking pretty good, if not really good in some aspects. But the vibes, the consumer sentiment data, the polling data on the economy was in the dumps. It was just, you would think that we were in the Great Recession or that we were in the Great Depression. I mean, it was so low. And so that disconnect. And unfortunately for President Trump, things looked better when he first got into office, but sitting here, a year into his term, he's got a bit of the vibe problem too, where the feelings on the economy, we just got some new consumer sentiment data. There's a couple of different places that do economic consumer sentiment, and one called the Conference Board just showed the worst consumer sentiment since 2014. And so I think, yeah, that's a problem. That's a problem for heading into the midterm elections. You gotta turn that around for Republicans and really for the nation as large. I worry that we've had so many years now under Biden and now Trump of this gloomy vibe session. It goes back to what you were talking about the easy button, or I was saying with some sort of hope button. We're getting to a point where Gen Z is so negative about all of this, that they almost start turning on capitalism or believing they're never going to get a home. And that's a huge problem that we want to avoid as a nation.
That consumer confidence rating that you just referenced, is that kind of a forward-looking metric or backward-looking metric?
Yeah, it's a bit of both. So all these consumer confidence indexes, they have both a present situation, how do you think, Chris, you're doing today? And then they also ask the question, okay, in 6 months or 12 months, how do you think your family will be doing? How do you think the overall economy will be doing? And it's a bit of both that have deteriorated, but the one that was the worst since 2014 relies more heavily than some of the other measures on people's perceptions of the labor market. And it goes back to this, the hiring is in the dumps and people are very nervous. Am I going to be next to be laid off? If I do, I'm screwed. I'm not going to be able to get a job for a long time. I thought I was stable. And so that this is an issue. They got to pick hiring up this year.
One of the things I look at, I live here in Central PA now for a long time. I grew up in Bucks County, suburban Philadelphia. And one of the ways I explain it to people is at some point in the next couple months, people are going to have to decide if they're going down the shore in the summer. We don't say going to the beach here. We say going down the shore, the Jersey Shore.
Yeah.
So are you going to rent a house for a week? Are you going to go to a B&B for a weekend? Are you going to skip it? because it's close by. It's a lot of family fun, but you can do a week in Europe for less money than you can, rent a house down the shore for your family, extended family. So that's what I want to see. I want to see not only are people doing it, but are the people who own those houses mainly to rent them, are they able to, get away with a price increase for that week in July, or do they have to hold steady? So um, that's going to be coming up here soon, and I'm thinking about it because it's 11 degrees outside here in Harrisburg. So
I need some hope on some level. But hey, you should be an economist. As you may know, two of the other leading indicators, you've done the beach house one, but RV sales are always another good metric to watch.
really,
Similar
okay.
ideal that when things are better for the middle class, there's more RV sales. And the other one that I always watch is Disney World, Disney World, Disneyland, seeing how their theme parks are doing. That's one people aspire to. Most people aren't gonna go every year in the K-shaped economy, but a lot of middle class families, you want to take your kid once. And it was pretty weak the last year and a half. Not to say they were empty. You know, you can see some of that strain.
Is cardboard packaging still a good
Yes,
forward-looking
also another
economic indicator? Explain, you're the economist. Explain why that is a good forward-looking metric.
Yeah, I mean, it's the basics of when more things need to be shipped, that means more people are buying things, both to be delivered to our doors and the Amazon, Walmart boxes of the world, as well as to ship certainly, made equipment, all of this AI data center equipment or whatnot across the country and around the world. I will say it's been a weird year due to tariff. One of the manufacturing industrial sector has been hit hard by tariffs, particularly the auto industry. And so in that sense, it's not the easiest indicator right now to read because it has been a tough sort of 9 to 12 months. So there's always this time is different in economics.
Is there anything you wanted to get to here that for some way, shape, or form I didn't get to? And anything you really want to get across to our viewers there as they deal with demystifying the economic data? We're going to hear in Pennsylvania in our governor's race, our legislative races, our hot congressional races.
I think we've done a great job of covering a lot. I guess two final thoughts I have, which is a lot of other nations have solved these problems. Like whenever somebody laments to me on childcare, I'm like, look, Japan, Canada, I mean, these are no extreme places. They figured out how to subsidize childcare and have an abundance of childcare. These are not rocket science to do this. And then I would just say the other thing to keep an ear out for in the economic discussion is the United States on the verge of a productivity boom. And partly due to AI, partly due to the way we've all learned to work a little bit more efficiently after the pandemic. Um, but productivity is through the roof. And in the 1990s, we saw something similar. And the good news was it ended up lifting. It was a rising tide that lifted all boats. All people across the income spectrum really benefited in the 1990s from that productivity boom. So that's my hope. It's not a political thing, but if it happens, it, it would be a huge, huge help.
Well, thank you, Heather, for coming on the PA Political Digest podcast as we work to hopefully demystify some of these economic terms we're going to hear in campaign 2026. You have a great Twitter account that I follow. So if you want to take a quick moment here and give people a way they can find you on the socials.
Hey, thanks very much. Yeah, by BY Heather Long. I've been using that handle since my Patriot News days, and I'm proud to have over 80,000 followers. I have both people in the Trump and Biden White House who have messaged me that they always pay attention to my tweets, especially on the jobs numbers. So I think that's a pretty good endorsement. Do I get a little political sometimes, but mostly I tweet the numbers and try to make sure people understand. I also have a Substack, Everyday Economics, trying to unpack every now and then a little more.
Well, thanks again for your time and stay warm, Heather. Thank you.
Yeah, well, I'll do my best. That beach house
Thanks.
sounds good. Bye.
Bye bye.